Good morning, everyone, and thank you for joining us for today's session entitled Latest Market Update, What's Next Investment Update, and Top Year-End Financial Planning Ideas. For those of you who are new to these sessions, CBM runs these market update sessions every other month, and these sessions are hosted by Counselor Buchanan and Mitchell and CBM's investment advisory subsidiary, MBI. Our presenters today are Debbie May and Alex Seleznev. Debbie is an executive vice president of CBM. She leads the firm's planning practice and is also the chief investment officer of MBI. She has 35 years of experience providing comprehensive financial planning and nearly 30 years providing investment advisory services. She is a certified public accountant, a certified financial planner, and a certified divorce financial analyst. Ms. May has been recognized 8 times by Washingtonian Magazine as a top financial advisor in the metropolitan Washington, D.C. area. Alex is a senior advisor and portfolio strategist at CBM, and he's also at the firm's financial advisory subsidiary, MBI. He is a certified financial planner and a chartered financial analyst who leads the firm's investment management division. His focus is on comprehensive financial planning and investment management. He is scheduled to present at the firm's 3 upcoming year-end tax and financial planning sessions on December 8th, 9th, and 10th, and you'll be hearing from us about those sessions shortly. As a courtesy to our presenters, please keep your video off during the session. There's a video camera button at the top. Make sure you click it so that the line runs through it so that your video is off. If you did submit questions during your registration, those have been shared with the presenters and will be addressed during the session. But if you do have additional questions during the session, please use the chat box. The presenters will be focusing on the content of their presentation and will handle questions at the end. If we don't get to your questions, please feel free to reach out to us afterwards. Slides will be sent to all attendees of today's session. If you are participating using your phone, please send me your phone number and name so I can make sure that you get to them, so we can get them to you. And again, thank you for joining us, and I'm going to turn this over now to our presenters.
Thank you, Joe.
Thank you, Joe. So welcome, everybody, and thank you for attending our session today. Just a little bit more about MBI. I mean, we are 8 years old as an investment advisory firm, fee only. We have a core group of 7 professionals, which consists of certified financial planners, certified financial analysts, and of course, and through CBM, we have lots of CPAs and estate and trust planners. Prior to MBI, we've been providing registered investment advisory work and financial planning for over 25 years. And right now we're currently managing about $250 million. And you can see that we provide comprehensive financial services, and you can go to our website if you're interested in learning a little bit more. Next. So here we are, the thinker. We're all turning a little bit green after all this volatility and becoming a little bit paralyzed with all the thinking that we're doing about what's coming up next. And with that, I'm going to turn it over to Alex. He's going to spend a lot of time talking about the investment update post-election, and then I'll be talking after that about some top year-end information and financial planning ideas. Alex?
Thank you very much, Debbie. Thank you. And again, thank you everyone for joining us today on this, I would say sunny but crisp November morning. Well, it's actually noon already, at least here in Maryland. So as always, we'll talk about the market conditions. We'll update everyone on what's been happening over the past couple of months or so. And there's certainly a lot of updates to discuss. We will share some of the strategies that we're considering at this point. And as Debbie mentioned earlier, closer to the end of our presentation, we'll talk about some of our tax and financial planning strategies. So in terms of the market conditions, and I'll start by saying that, perhaps some of you who joined us, previously, perhaps you noticed we're mostly referring to the Dow, or the Dow Jones Industrial Index. Going forward, we thought we would switch 100, which is a more inclusive index. It consists of 500 stocks, as the name implies, and perhaps it provides a better representation of the U.S. economy. So we started this quarter specifically at 3,400 points. As of this morning, we were 305.60 points for the S&P 500. And that gives us a pretty, healthy increase of almost 5% for the quarter. In terms of the year to date, the S&P is up almost 10%. In terms of the Dow, consists of 30 stocks. Some people refer to it as the, old economy stocks at this point. The Dow is up 3% for the year, and then the NASDAQ, more of a technology-oriented index, more than 50% of the NASDAQ components are technology stocks, is up 32%. 32% in a year such as 2020. Well, that is, telling you something. So in our presentation today, of course, we'll talk about different reasons of why we believe the markets moved up this much. We'll share our thoughts. But if you look at it, let's say from the big picture perspective, and you think of an investor, perhaps a pension fund or some kind of institution that needs to achieve, let's say, a rate of return of 5 or 6%. Well, how are you going to do that? Essentially, you have three pots. You have stocks or equities, you have bonds or fixed income, and then you have cash and cash equivalents. Of course, there are other asset classes as well. Cash, as many of you know, is essentially earning almost nothing. Perhaps you'll get somewhere between 2 to 3% from bonds, in many cases less, depending on how conservative you are. So essentially, stocks is one of the only ways to achieve those rates of return, and perhaps investors are looking for ways to stay in stocks, which is one of the reasons, again, this rally seems to continue. Now, in terms of the S&P 500 itself, something that we've been paying attention to, as of this morning, I actually checked as of this morning, 281 companies, or 56%, are in the positive for the year. Well, why is that important? For any of you who are, paid attention to this in March, only seven companies in the S&P 500 were in the positive in March of this year. Of course, that's when the markets were down more than 30%. By June or July timeframe, the S&P was hitting the positive for the year, but it was mostly driven by 30 to 50 companies, mostly technology stocks. So where we are today, it's more of a broad-based rally. Of course, we would prefer to see, 80, maybe 90% of the stocks in the positive, but still 56% is certainly better than, let's say, 5. In terms of coronavirus, of course, many of you are aware, the situation is unfortunately getting worse. Over the past couple of weeks, specifically, the number of cases around the nation is up by more than 50%. 250,000 people, more than that actually, unfortunately, died. Year to date, we have 11.6 people who actually have or had coronavirus. So perhaps in the short run, it's not necessarily going to get better. That said, though, over the past couple of weeks, we had some really positive updates on the vaccine. Pfizer, they were the first ones to report their preliminary results, and their success rate seems to be at the time was 90%. Just yesterday, they came out and said that it's actually closer to 95%, and they'll be seeking the FDA's approval shortly. So, perhaps we'll have their vaccine soon. Plus Moderna, they actually they disclosed that information on Monday, I believe, and their success rate is 94.5%. There are other major medical companies that are working on the vaccine, so we're expecting those updates as well. And of course, there are other companies around the world that are working on it. For those of you who are following Dr. Fauci, he gave an interview over the weekend, and I would say it was one of his perhaps most positive interviews so far. I mean, I'm not going to necessarily go over the whole thing, but perhaps things will go to some kind of normal by the second part of next year, perhaps by next Thanksgiving. So of course, we'll wait and see. Now, with the vaccine updates, one of the perhaps most notable short-term investment things that we noticed is this so-called rotation from growth to value stocks. And for those of you who are perhaps less familiar with that, well, growth-oriented stocks are essentially technology, consumer discretionary stocks, those that are expected to grow their revenue significantly. And then on the value side, these are more, more mature companies. Many of them tend to pay dividends. Financials would be a good example, industrial stocks, energy, of course. So we started the month actually on November 1st. Value as a category was down 17%. Growth as a category is up 25%. So it's a spread of 42%, which is quite significant. So over a period of what, six to 7 days at this point, it narrowed by 8 percentage points. So it's something that we're certainly paying attention to, especially from the perspective of rebalancing our portfolios. In terms of the sector performance, overall remained more or less the same compared to our previous webinar 2 months ago. At this point, technology and consumer discretionary are leading the way, and then energy and financials are essentially in the bottom. That said, though, when I first started working on this webinar over the weekend, both energy and financials actually climbed up by 8 percentage points just for this week. So again, there is that sector rotation happening. Now, one of the things, of course, we're not going to skip, perhaps the most significant event that we experienced in the month of November, is, of course, the US election. So for those of you who participated in our September webinar, we essentially outlined our thoughts on the 3 most likely scenarios from our perspective, status quo or the blue wave scenario. But essentially what we have at this point is the scenario 3 that you see on your screen, the idea of having a split government. From our perspective at the time, and essentially we are at this point, we do believe that it's essentially the friendliest scenario for the markets. And again, I am mostly referring to financial markets here. And the idea behind it is perhaps we'll see the continuation of the existing favorable corporate and individual tax policies. Perhaps not so much in the deregulation side, as many of you know. Mr. Biden will be quite focused on climate change, so we'll see what's going to come out of that. But also in terms of international trade, and foreign policy in general, foreign policy. I'm not necessarily saying it's going to be all that friendly, but perhaps it's going to be more predictable, and markets certainly like predictability. In fact, the week of November 2nd, right? So by November 6th, we had the best weekly post-election performance since 1932. All 3 major indices, again, the S&P, Dow, and NASDAQ, were up between 6 to 7%. So that tells you something. People certainly like the outcome of that. Of course, we'll be paying attention to what's going to be happening over the next couple of months. We'll see what's going to happen in Georgia in the beginning of January with runoff elections. But for now, we like what we see. So this chart, the so-called asset class returns quilt, actually happens to be one of my favorite charts to look at. We look at it internally, usually quarterly, and then we discuss it with our clients or in our webinars closer to the end of the year. So what you're looking at here, you're looking at the performance of each major asset class for each year from 2010 all the way to year to date or 2020. So if you look on your on the second right column where it says YTD or year to date. So large cap domestic stocks are leading the way as a category. They're up 13.3%. This is as of Friday, by the way, so it's slightly different as of today. Mid caps are up almost 8%. That may not sound all that significant on the surface, but many mid caps were down as much as 20% or more by the end of March of this year. So that gives you a pretty significant recovery of close to 28%. Emerging markets are doing quite well as a category. They're up more than 7% for the year. China or Chinese stock markets happen to be the best performing year to date for major economies. Chinese stocks are up more than 20% for the year. Domestic bonds as a category doing quite nicely, in some sense as expected. Plus, of course, with interest rates are essentially at zero. We had 2 interest rate drops this year. It's at 6%. Going forward, though, we're not expecting that to be the case. going forward, and that's one of the comments I wanted to make, and we'll talk about that more, we're expecting something like 2 to 3% or maybe even less for those who invest in bonds. Balanced portfolios, essentially a split of 60% stocks and 40% bonds. Interesting enough, performed exactly as expected. For our internal models, we're projecting that balanced portfolios would return 6%. Just happens to be exactly at the target for the year. Small cap stocks are perhaps the most interesting. 5.2% for the year. Again, this may not be all that significant to you. Small cap stocks were down by more than 40%, by the end of March. So that gives you this astonishing recovery of more than 45% over 6 to 7 months period. Developed markets are essentially flat for the year. Developed international markets, as you know, many of them are struggling with coronavirus, plus they have quite a lot of macroeconomic issues. Cash alternatives are in the positive, but essentially flattish, and that is, cash, money markets, and certificates of deposits with maturities of less than 1 year. Commodities as a group are in the negative by 8%, with the exclusion of gold and silver. Both of these asset classes performed quite nicely, more than 20% for gold and more than 30%, if I'm not mistaken, for silver. But the rest of the commodities are down for the year. And then finally, real estate, as we're referring to the real estate investment trusts, so publicly available investments, is down 15%. So that's where we are at this point. There's much more that you can learn from this chart. A couple of things to point out. If you look at 2020, 2012, and 2017, notice that emerging markets, significantly outperformed other categories. Well, maybe not so much in 2012, but certainly in 2017. They tend to be very volatile. They tend to be very cyclical. They do, at least in our opinion, require more active management, and at least they require more frequent rebalancing. And we'll talk about that in more detail later. Similar for small caps. Notice in 2013 and 2016, they were the best performing asset class. Perhaps if you look at other years, emerging markets were closer to the bottom, not as drastic for small caps, but still, it's a pretty volatile asset class. And of course, for large caps and balanced portfolios, you would expect them to see somewhere in the middle. And then finally, commodities, they tend to perform poorly over the long run. There's actually a question that we'll cover later, but as a group, they haven't performed all that well. So in terms of the economic indicators, where we are in terms of our thinking going forward. So the four major ones, of course, the unemployment rate, I'll start with that. That's the red line on your screen. So we started the year at a pretty healthy 3.5%. It was essentially a historic low. But then, of course, coronavirus happened. Unemployment rates increased all the way to 4.7% in April, but then they gradually declined all the way to 6.9% in October. That's the latest data we have. Now, anytime I talk about unemployment rates, that's just the official figure. Those people that regain their jobs, in many cases, their wages are not as high as they used to be. Plus, of course, there are those people who are no longer seeking employment, so they're not part of this 6.9%. So there's always much more than the rate itself. In terms of 2021 estimates, there are models, and one of those models is developed by Trade and Economics, and essentially takes into consideration different variables to estimate what it would look like in 2021, so 6.5%. There is a reason you see a question mark there, because there are a lot of factors that will have very significant impact on that. I don't have to go far here. How well we handle this whole coronavirus situation will have a huge impact on the unemployment rate in 2021. The stimulus package that we were hoping would pass this year, perhaps not this year, perhaps in January or February of next year, the expectation is that it's going to be somewhere between $1 to $3 trillion, depending on how well they essentially negotiated. That will likely have some impact. So this is something we're really paying attention to. For those of you perhaps not familiar with why people are doing this, so 5% is considered to be full employment. Just so you know, it's considered to be frictional unemployment of 5%. So in order for the markets to continue advancing, at least from the perspective of unemployment rates, it doesn't actually need to go back to 3.5%. In terms of the US GDP, we're still expecting a decline of 3.5%. This figure hasn't changed since our last webinar 2 months ago. We're still in the middle of the fourth quarter. Perhaps things will get better, or perhaps they'll get worse. So that's not necessarily the final figure. Now, for 2021, there's a lot of different articles and white papers I personally looked at. Essentially, everyone is expecting to be in the positive, somewhere between 5 to 6.7%. 5% is actually what the Fed is saying, and 6.7 is by one of the major financial institutions. 5.3 happens to be the average, and we agree with that estimate. In terms of inflation, currently at 1.2%, it actually picked up over the past few months. It was at 0.2, if I'm not mistaken, in June of this year. So it picked up since then. It should be more or less the same in 2021. However, again, depending on how well we tackle the coronavirus situation, perhaps there will be more economic activity in the second part of the year, in the second part of 2021, and perhaps we'll see more inflation then. Again, we'll pay attention to that. So, in terms of the strategy, for the rest of the year, and of course going forward, or at least for the next couple of quarters. So what we thought would be logical is to split it between so-called conservative or more income-oriented investors, and then on the next slide we'll talk about more growth-oriented. That said, though, there's no reason why you wouldn't combine the two if that really makes sense for your personal situation. So perhaps one of the most important, one of the best ideas at the end of the year, essentially at the end of any year, and specifically in a year such as 2020, is to stress test your assumptions, revisit your overall investment / financial plan, and specifically revisit your allocation to bonds. So start with the stress testing here. You go back to March and April of this year. Perhaps something was not comfortable to you. You didn't like how certain investments performed. In our April and May webinars, we explicitly said that you should really stay the course, don't change it, because again, the markets are so volatile. Since then, I would say many, perhaps even most investments, with the exclusion of certain categories, pretty much fully recovered. So if you're looking to make changes, now is perhaps a good time, just from that perspective. Now, specifically for those of you who invest in, again, a so-called balanced allocation of 60% stocks and 40% bonds, or maybe even more in bonds becomes more important, consider revisiting that. Well, why would you want to do that? Let's say that you're projecting your long-term rate of return to be something like 6%. Now, that essentially implies, if you're invested in the 60-40 allocation, then your stocks need to earn 8% and your bonds need to earn at least 3%. Now, if your bond allocation is now earning you something like 1, if you're very conservative, very much cash-like, high-quality bonds, well, that gives you your projected rate of return of something like 5%. And that is again on 60-40. We do have clients who invest, 30% in stocks, 70% in bonds. So for them, perhaps would be more probable that they would earn somewhere between 3 to 4%. How would that affect your planning? Do you need to make any changes again, based on your cash needs? If you decide to make those changes, you certainly have multiple options. One of the options is to increase your allocation to dividend growth funds, something we discussed in one of our previous webinars. These types of investments pay usually somewhere between 1 to maybe 1.5% in dividends as a category, but they have a history, usually a strong history, of increasing those dividend payments, in many cases by 6, 8, sometimes even more percentage points per year. So what are you gaining? Well, yes, your portfolio would become more aggressive, more volatile if you decide to go this route, but you're gaining more growth. You potentially gaining more income that some of your bonds would be earning, plus that income would increase over time, which would give you some protection potentially against potential future inflation. Preferred stock is on the table, something we also discussed. When we first brought this up, preferred stocks as a group earned somewhere between 6 to 7%. The valuations came up since then. At this point, you're looking at something like 5%, which is still, quite significant. And with preferred stock, for those of you who are perhaps less familiar, somewhere between stocks and bonds. Certainly less risky than stocks in general, at least, but more risky than bonds. But again, the main reason why you'd want to consider those is higher yields. That's what would drive that decision. Finally, if you're comfortable with your overall split, 60-40, 50-50, whatever it is, well, you may want to consider adding some total return multi-sector bond funds. And again, the main reason you would want to do that is to increase the income that your portfolio earns. That would, of course, increase your overall risk as well. With total return bonds, there's also a potential for some capital appreciation. Those types of strategies tend to be more active, so they actually sell bonds prior to maturity. So, consider that if you want to keep your allocation the same. Finally here, talking about, more favorable foreign policy, consider at least revisiting your allocation to international stocks if you're looking for higher yields. As of yesterday on this particular slide, international stocks yielded 2.3%, 2.4%. The S&P 500 is at 1.5%. One thing that I'm not showing here, and that's many people refer to that, international stocks as a category, same as emerging, are almost always sold at lower valuations. It's just the way they work. Growth rates for those types of markets are usually less, and international markets are usually less technology oriented. So it really shouldn't be driven by the relative valuations. You should be looking at, other reasons perhaps. In terms of, so-called growth-oriented investors, or essentially those who prefer to keep most of their investments in stocks or equities, well, the best idea is to revisit your allocation to growth-oriented stocks or funds. There's a good chance that if you invested in technology or consumer discretionary stocks, you're sitting in a pretty significant, pretty hefty gain. Perhaps this is a good time to take some of those gains off the table. Now, I am not saying that technology stocks became less healthy. They still have plenty of cash. Many of them have bright futures. But again, those valuations, they became quite significant as of November 19th. Now, I brought this up with one of the clients actually last week, and the response I got, well, you know what, Alex, I don't actually have any technology stocks in my portfolio. I don't have any individual stocks. Well, a lot of that is, of course, inside of your mutual funds. One, quick and dirty way of looking at it, if you have an equity fund that returned more than 20% for the year, meaning more than the S&P 500, chances are it's having technology, and you may want to look into that. Now, if you decide to go that route, and if you want to keep your allocation, in equities, what are some of the alternatives that are available to you? Well, more economically sensitive companies, such as mid and small cap stocks. Again, they tend to be the first ones to go down in times of market volatility, but they also tend to be the first ones to recover when there is a possibility of economic growth. And that's again in the context of the vaccine situation. It doesn't. I'm not saying that you do it now and it's only up. Chances are there will be quite a bit of volatility, but again, it's always forward looking. It's always forward looking is how we would approach this. Revisit your allocation to emerging markets, again, back to more favorable trade policy. And as perhaps many of you know, specifically China, they handled the coronavirus situation much better than many other countries. Plus, one of the things that you do not see on this slide, as we keep essentially printing money in the form of providing more stimulus to stimulate our economy, chances are the US dollar will get weaker compared to other foreign currencies. And from the perspective of a US investor, again, investing in those types of markets, that is to your benefit. So that's this additional factor. Finally, if you like everything I just said, or perhaps you don't like anything of what I just said, you want to keep your allocation as is, consider again taking some gains off the table in a year such as 2020 and rebuilding your reserves so you can take advantage of more volatility going forward. And with that, I will ask Debbie to talk about some of our top tax and financial planning strategies.
Well, thank you, Alex. That was very comprehensive. And I do have to say, I really love that quilt that you put up there that shows the variety of returns and how volatile it can be and different it can be. And I think it just really points out the need to be diversified, to rebalance, and take those gains off the table and keep your portfolio adjusted for long term. And you can see how quickly it can change. So I just wanted to say before we got started on our top 10 ideas that we want to share with you, that it's true that there was a lot of concerns about what would happen with year-end tax planning this year because of a Biden administration, and clearly, taxes would go up and maybe estate exemptions would go down. But we do have a divided Congress, with the Senate being on the Republican side. So we are expecting, to Alex's point, that it's going to be pretty much nothing happening that in 2021 to speak of. However, I think as we're going into 2022, and even the Republicans are going to recognize how much money the government has had to spend between the Tax Cuts and Tax Cuts and Jobs Act, the pandemic relief programs, the CARES Act, probably another big stimulus package and pandemic relief. There has to be a point where taxes have to be covering some of that deficit. So we're probably for this year, talking more traditional year-end tax planning, where we're looking at the kinds of things we would have looked at even in the past. And we're trying to look at 2020 and 2021 as they relate to each other from your own particular situation. So the next slide. So the first one, sticking with the sort of investment considerations, is the capital loss harvesting. And we have talked about that before, that you don't want to be ending, in our opinion, the year and leave unrealized losses on the table in your taxable accounts. Taxes can be significant. Capital gains arena, between federal and state, it can be as high as 25%. So why wouldn't you want to bank some of those losses against future gains? And it will give you the opportunity to reinvest in similar holdings. You don't necessarily have to, you can't invest really in the same thing and take that loss, but you can also, to Alex's point, take an opportunity to rebalance, to rethink your, positioning, so that all frees up cash for that reasoning. And you can take that into the future. So even though a capital loss is limited to $3,000 per year in any 1 year, again, once it's netted gains, it can be carried forward into the future. So we think that that's a very beneficial thing to do. Once the year ends, you can't go back, obviously, and do that. So you want to make sure that you've done that at least by 12/31. And I would say even if you did some loss harvesting back in March, when the market took a significant dip, you would want to do that again. And again, you're banking that for the future tax savings. So the next thing that we have on here is deferring income and accelerating expenses. And that's always kind of been the case with any short-term tax planning. It's easier when you're self-employed, as I pointed out here, because you can defer your billings, you can prepay and pay off all of your expenses that you have, and that's going to reduce your profit. When you're a W-2 type employee, that's a little bit more challenging because you'd have to, be deferring a bonus or trying to defer, some type of income into January, and that would involve, your employer. So that's a little bit more challenging. So the next slide. So number 3 is really bunching deductions. And what that means is you're really planning with, am I in a standard deduction, which is now quite large, $12,400 for singles, double that, $24,800 for married couples. And so a lot of people are finding themselves in that standard deduction, because if you don't have a significant mortgage interest or significant charity The tax deductions limited in terms of state income taxes and real estate taxes. A lot of people are falling into the standard deduction. So when you do have deductions such as I mentioned, medical deductions, let's talk about that first, and you think you might go over this 7.5% medical, which includes also, any health insurance premiums, long-term care. You might want to see if you're going to cross over that, which would allow you maybe to go over the standard deduction. You want to bunch those into 1 year. You don't want to necessarily take some in 1 year, some in the other. You're probably not going to get any tax benefit. So just something to pay attention to if you're in that scenario. The other one is charity. And I would say that this is, a bigger one. For people to plan. I mean, if you're giving money to charity, you don't want that to be always absorbed by the standard deduction and there is no tax benefit. So you could obviously try to take a significant amount in 1 year and not necessarily do it the next year so that you get over the standard deduction and you're getting some tax benefit. And remember, for most people, even in the broad brackets, we're talking about probably 33 cents on the dollar at a minimum because our state income taxes rates are pretty significant here. So that's an idea. If you're wanting to do a more significant amount of charity, I would say the new kid on the block is really these donor advised funds, which I have listed, where you actually can deposit money maybe for multiple years, where you're looking at maybe 5 or 6 or 7 years of your potential charity, investing that into a charitable account, giving it to the donor advised fund that's invested. And you can do small amounts of charity that way as you would like over time, but take that deduction all in 1 year. So that can be pretty significant for a lot of people. And you can use your appreciated stocks and so forth that have big unrealized gains so that you can avoid paying tax on the gain. That donor advised fund people, the charities don't have to pay that tax. So that's even an added advantage. But obviously you have to fit into that category in terms of feeling like you've got the liquidity to do so, the charitable intent, and that acceleration, though, can be quite valuable. We're having a lot of our clients we're talking to about that now because of, again, the high standard deduction. So that's sort of the bunching deductions so that you can, again, get some tax benefit beyond the standard deduction. And you're always looking at 2021. The reason you're looking ahead is to say, well, how is 2021 going to come out compared to 2020? So that you can plan those 2 years, that timing, effectively from a tax perspective. Now, falling into that is there has been the postponement of the RMD. You're not required to take out a required minimum distribution from your IRA. If you were over 70 and a half or you had an inherited IRA, that has been postponed to 2021. Not that you have to take 2 in 2021, but you will just restart your required minimum distributions in 2021. And for people that are now it's not even required going forward. If you're under age 72, starting this year and going forward, you can postpone that as well. And that is our feeling, is that you should postpone it to 2021, even if you need to take it out January 2nd, unless you're in an unusual tax situation that you've got a very, very low bracket for some reason, or maybe no taxable bracket, and you'd want to calculate how much do I take out just to take advantage of my low tax bracket situation this year. So that's something to look at, as well as some people were giving their charitable deductions when they were over 70.5 directly from the required minimum distribution IRA, which was a great planning idea because you're getting it right off the top. However, we still think you should postpone that to January 2nd, even if you wanted to do that, because it's just from a calculation standpoint, it's just going to lower what you're going to take out in the future, but by a minimal amount if you take it this year. So do it January 2nd. And of course, you can then double up because now you're going to be maybe having more cash to do that with. So that's the other idea there. I should mention that there is this year the ability to take a $300 deduction on the top towards charities, which is a new thing, but it's $300 is what that is, above the line, not falling into itemized deductions. The next item we have, number 5, is personal gifting. So where you're looking and inside your family or relatives, let's say, we're talking about that. The annual gift limit is $15,000 a year per person. And for a couple, obviously that can be $30,000 to a particular individual per year. And so if you don't do it by the end of the year, in terms of using the gift exclusion amount, this amount, then the year's over and you're into a new gift exclusion amount for 2021. And if you want to do that, and if you're looking at potentially down the road in a Biden administration where the estate exclusion amount may come down substantially and you could be in a taxable estate, then you're motivated to do that from that perspective. And you're even more motivated maybe to use up part of your lifetime exclusion, as I mentioned, in a bigger way, in a more substantial gift now, in order to protect that. Because generally we don't have things going retroactive in terms of changes. It's usually prospective. You would be grandfathered into having done that transfer. So that's important. And then of course there can be personal reasons that you're wanting to transfer money to the next generation or grandkids or that sort of thing. The next slide. So number 6 is talking about Roth conversions. And we've talked about this before, very significant planning where you've got a traditional IRA that's just deferring income into the future, will be taxed in the future on a deferred basis. The Roth is earning money tax-free, and when the distributions are made in the future, they will be tax-free. And if they're inherited, they will also come out, and it's a 10-year period now that has to come out, but it will also come out tax-free versus tax-deferred. What's the downside is potentially when you're going to convert this traditional IRA to a Roth, in the year that you do that, whatever portion is taxable will be taxed up front. So again, I would say that we're not necessarily leaning towards wanting to pay a lot of taxes up front for this advantage. There could be particular reasons in your own situation, but we're usually looking at it from a tax strategy. Again, at the end of this year, are we going to be in a low bracket or a lower bracket than normal? And maybe we do some conversion. It's not an all or nothing proposition to take advantage of that. Or are we really concerned, like in 2022, 2023, the rates may go up substantially. You might want to sort of hedge your bet and do some conversion for that reason. You also might be in a situation where you've done a lot of non-deductible IRAs in the past. And so when you do that conversion, only the growth is taxed for that, so that that could be very advantageous as well. Or if you're still working, there is something called a backdoor Roth where you can put some of that taxable portion in your employer plan and then only convert the portion that's not taxable, the basis part. And also, once you do that, every single year you could deposit into an IRA if you're still working. There's no age limit anymore, by the way. And you can then just flip that into a Roth conversion as well. So there's a lot of planning around this. Again, it's something you want to look at, I want to say, every year and see what you can be doing. We don't know when they're going to necessarily close some of those doors with new tax laws as well. So I think this year and next year is a really good time to be looking at that. Number 7 is just retirement contributions in general. We all know this, but again, once the year ends and that tax return is filed, you can't go back and make a retirement contribution. So you're trying to, again, we're looking at tax advantages here that have powerful economic benefits too. It's your money. So all you've done is take advantage of a tax, situation to reduce your taxes, and you've still got that money economically in account, now growing tax deferred. And the kind of things we've listed is obviously for people working, you probably still have a 401k, a 403b. If you're self-employed, there's a variety of plans, and you can actually change the type of plan you're in by the end of the year. You could maybe do a solo 401k, a defined benefit plan, a cash balance plan, and of course the SEP IRAs. And the SEP IRAs, you don't even have to set them up until you file your tax return. So you can be looking even after the fact to see what advantage you have and get that set up prior to your tax filing. Also making those IRA contributions I just mentioned. So being able to contribute to a traditional IRA if your income is higher, that may be all that you have the option to do, like $125,000, I believe, if you're single, and about $195,000 if you're married, and some phase outs. But still, even if you have a plan and it's not deductible, again, we're trying to take advantage where we can of having tax deferred situations, not only now, but into the future as you're taking money out over your retirement. And I've given you sort of what the limits here are in terms of what you can put in. So it's not huge amounts, but it's something. And there's no age limits to contribute. Next one. So number 8, this is one of my favorites to bring up. And again, when we have an ideal financial planning situation, we're able to look back a generation, look forward a generation, and really get to understand what the needs are of the entire family, maybe even grandchildren. And so here we're looking at trying to have more wealth and opportunities in that holistic way. So you're helping your children take advantage of tax deductions. And this one I like to bring up because sometimes with, let's say adult children, they've got mortgages and they're itemizing deductions. And even though they might have lower income than you have, they're still getting 25, 28% benefit. So if you're not going to get something for your charitable deductions, why not gift some money to them and let them make it? If the ultimate goal is to get it to the charity, that's a way to at least get a tax benefit. So you want to take advantage of that. You also might want to help them contribute to retirement. I mean, very often with the younger adults, it's hard for them to even max their 401k. Some of them aren't even taking advantage of the match. That's free money from their employer. And the reason is obviously competing against paying down student debt, trying to save for a house, other cash flow stressors that might be out there. And you might be able to step in and gift the money so that they can put the money in the retirement, including Roths. A lot of times their income is low enough to take a Roth deduction, not a deduction, but contribute to a Roth that's growing tax-free, that they may not have that ability in the future. And we know that there's also more advantages in how the money can come out for various purposes. So that's something to consider. 529 plans, then this is the college savings plans that you have by state. Maryland, DC, and Virginia all have them. And if you put money into those, there is a deduction at the state level. So again, you might be getting anywhere from almost a 6% to 9% immediate return just from contributing that much money. And it's $2,500, $3,000, something like that per year that's deductible on the state level. And that money is growing tax-free if it's used for college. And that can be even for yourself. You can be the beneficiary of your own plan and later change it to, I have that myself, and later change it to my grandchild whenever my grandchild comes, which is not here yet, he or she. But I'm already doing that because I want the state benefit and I want the state tax benefit and I want the tax-free growth there. It can also come out, I mean, it's flexible. I don't want to make this be all about, we could talk an hour about 529 plans. But it's also a way to be thinking about, well, geez, I could be saving for my grandchildren, even my children. I can change beneficiaries. I can get some state tax benefit. It has to be set up by the end of the year. Very easy to do. collegesavingplans.com, and you can go into your particular state plan, set up an account. You can even set up automatic withdrawals if you want to put in a few hundred a month to get to your max next year. That's what I do. So that's just, again, another way to save. We don't have a lot of opportunities to save our own money in these mechanisms of getting some tax benefit, getting some deferred, or getting some tax-free growth. The other one that I like to bring up is, again, keeping the money in the family. We have, let's say, adult children or relatives that are paying a bank or paying for a car loan, paying student loans, whatever it is, and maybe it's a fairly significant interest rate, given what Alex was saying about where interest rates are going to go, which is almost virtually zero, and you want to have some fixed income. Maybe you become the lender for your adult child, and they're paying you 2.5% or 3% or more, whatever it is, with a bona fide loan agreement, promissory, everything business-like is where you have that dynamic that can work. Again, you're getting more money. They don't necessarily have to deal with a bank, pay more loan costs, maybe even pay a higher interest rate. And we've done that a number of times when the circumstances are right. Again, the idea of keeping the money in the family. Next slide. So number 9 is a big one. I think it's always a big one about long-term planning, living well in retirement, we're calling this. And that is looking really at your retirement projections. We call it a benchmark. And we have a sheet of kind of assumptions that you should be looking at when you're trying to project that. There's a lot of models that are online, but I think it's probably better to customize it a little bit more for your own self, thinking about longevity and inflation and what your rates of return are going to be, when you're going to retire, what assets you're going to count, all of that. So you do a benchmark, so at least you know status quo where you're going to be and what changes you need to make. It also informs you about how your assets should be allocated, growth, inflation, need for income, how soon, those kinds of things. And also having a safety net. And people often talk about their safety net of being reserves, or what happens from a risk standpoint that's not investment oriented. What if there's a health issue? What if my parents need money? What if my kids need money? What if something happens? And that brings you to the whole discussion generally about insulating yourself to some degree. What might be insurance related, it might be how you think about your real estate, how you think about your investments, and how that's going to change your spending. So it's all related, maybe even changing your tax situation. So that's, I think, very, very, very important. I mean, we always do this type of projection with our clients in order to figure out what a good game plan is going to be for them. And also safety nets. And I say, does your safety net have a hole? And these are the kind of things that we talk about too, like what can go wrong with this picture besides this, or, what if you live longer? What if you don't get that inheritance? What if something major happens to you again? From any standpoint that we can think of, we're just trying to figure out what can go wrong with this picture, not just investment related. And safety nets can also be real estate. That kind of moves me into the last thing here. So real estate, a lot of times people don't want to count their real estate necessarily in their retirement projection. This is where I live. I'm not planning on spending my house. And that can be something that somebody could inherit down the road. So we often talk about that, like even if you spend all of your resources, financial resources, liquid resources, there's still the house, and we have to bring that into the conversation. Might go up a little bit. Mortgages get paid off just by natural amortization. Equity is built. So that can be a safety net, and that can be a way to think about your net worth. And very often when we do a net worth statement for clients, we say, here's your cash, here's your investments, here's your retirement. No, by the way, here's your house. If your house is worth $1 million and your portfolio is $3 million, well, guess what? 25% of your net worth is in that real estate. So you need to be talking about it. What does that mean to you? Does it mean I may have to tap into equity in the future if I needed to? Maybe I should have a home equity line of credit just available. Maybe I should think about, well, you know what? If worse come to worse, I could downsize and live in something that's $800,000. So that's all conversation. And then I have clients, these three bullet points come up a lot, in my career. Like, should I make these home improvements? Is this silly? Of course, right now, everyone's making home improvements. I'm having a hard time getting my contractor to come over. They're very busy on the personal, residence situation. There's a really tight inventory of houses on the market. Interest rates are at all-time low. People are doing a lot with their real estate. I'm going to maybe buy, upgrade, improve. And so we're talking about what does that mean, not just from the standpoint of personal enjoyment, but am I going to get that money back? Does that feel comfortable? Real estate costs money. I mean, it is the place that you can make some money, and we do analysis for people, whether it's a vacation home, whether it's I want to maybe think about a rental property to add to my portfolio mix. We talk about the pros and cons. Real estate is not a passive investment. It's going to have hassle factors with it. It's going to have, risk factors with it. It's very illiquid. You could have, a lot of expenses with the house. So when they think of my house went up in 10 years, 50 grand, that's great. But how much did you actually spend during those 10 years keeping it up? So we have to have the personal enjoyment, as well as the investment side come together when you're having those conversations. Next slide, I think, will be questions. So we saved about 7 minutes, and Alex, we had some things that came in advance, maybe some chat. So
that's right. Yes, and again, thank you, Debbie. And one thing I'll mention, I'm glad we're doing this on November 19th. So if any of you are, thinking about implementing any of the strategies that Debbie mentioned, you certainly have plenty of time to do it. So consider doing that.
Yeah, and I would say, I'm sorry, one more thing. We do have, and just to reiterate what Joe said, we do have another year-end tax planning strategy presentation, December 10th or 8th, 9th, 10th, where that will probably be much more detailed than what I just covered now, if you have more interest. I'm sorry, go ahead.
Well, no problem. So we have, I guess we'll take 2-3 questions here. Here's the first one. What do you think of gold and silver as alternative investment options? So I guess this one is toward me. So this question actually came up prior to this webinar. So that's fine. From our perspective, if anyone wants to include some gold and or silver in their portfolios, we're perfectly fine with that. One thing we'll mention, the track record for both is relatively poor, at least from the performance perspective. I'm not saying it gives you some safety that you have some gold in your portfolio. That's fine. Specifically, over the past 10 years, and I'm looking at the reports right now, gold returned 3.3%, silver returned 0.15%. And by the way, silver is referred to as poor man's gold because it's almost always sold for a lower price. In comparison to the S&P 500 that returned 13.6% over the past 10 years. Now, in a year such as 2020, silver is up a little more than 30% and gold is up almost 23%. So we consider both as fear assets, tend to perform well in times of market volatility, and they tend to, especially gold, not so much silver, they tend to provide some hedge against inflation. Can you have a portfolio that it consists of no gold or silver and be successful in the long run? Absolutely. If you want to include it in your portfolio, that's fine too, but consider doing it for more tactical than strategic reasons. There's another question here. For my estate planning, can I give someone a Roth IRA, designating them as my account beneficiary as a form of bequest, ? I would establish several Roth IRAs for this purpose for adult nieces and nephews. If so, is that something that I can/should do as part of tax planning? So perhaps this one is for you, Debbie.
Yeah, well, you can, you do designate beneficiaries on IRAs, Roths, IRAs, 401ks, your life insurance even, and those will go directly to the beneficiary that's listed. Sometimes having the multiple accounts and allowing beneficiaries to make their own choices with that is fine. It's not really incorporated into your will. It's separate from that. So whether you should or shouldn't do it that way, I can't answer that perhaps, but that's how it works. When the IRAs are inherited now, they have to come out over 10 years. It used to be over their life expectancy, but now whether it's a Roth or traditional or qualified plan, whatever it is, it has to come out over 10 years. So it is a shorter period, and some people are revisiting what that means to their planning.
All right, so I guess we'll take two more questions. One is from the chat box. Real estate funds being down mean real estate prices are down. So that's the actual question. So I believe this person was referring to the asset class returns quilt when I was referring to real estate on the bottom of this chart. So not necessarily is my short answer. So what we included on the slide, and maybe it's a little deceptive, are so-called real estate investment trusts or REITs that are publicly available. It does not necessarily include the entire universe of real estate that is out there. Specifically, it doesn't include many developers, and especially developers, many times they're not structured as trusts. In this particular case, it's mostly about their projected income going forward, meaning their multiples, perhaps went up because their income is expected to be less. So that's one of the reasons they're down for this year. As many of you perhaps know, certainly in our area, real estate prices for residential real estate are certainly going up, not necessarily going down. So another question, I guess we'll take the final one from the chat box. If I remain in the same bracket, should I convert from traditional to Roth IRA? What do you think about this one, Debbie?
That's hard to answer in a vacuum. It could make sense for a lot of different reasons, depending on what your overall portfolio looks like and what your availability is to have cash to do the conversion, or what you think about tax rates going forward beyond 2021, not just this year, next year, and what's going to happen down the road with that growth. And so you do have to still do some projections. It can't just be done, just because you think you'll be in the same rate or even a lower rate, to be honest with you. So I think I can't answer that any more specifically than that, unless you have something to add, Alex.
Well, that's my only comment. With Roth conversions, it's always client specific, or to be situation specific. Very few times it's a no-brainer. Very few times, I'll tell you that. And usually would know, like Debbie mentioned earlier, if you find yourself in a situation when you have absolutely no other income, and let's say you have capital losses for the year, well, sure, perhaps that's a little bit of a no-brainer, but it's still relatively rare. Almost always it requires at least a conversation.
Yeah, and I want to say sometimes for the older generation, if you're looking back at parents or whatnot, and if they're unfortunately having a substantial medical deduction situation, a lot of times assisted living, nursing home that's deductible causes a negative taxable income, and they're sitting there with an IRA, that's the time it's kind of the no-brainer to say don't end the year in a negative taxable income situation, because there is no benefit for that. So look for income that you can bring in if it makes sense, and that could be one of them.
Sounds good. So I guess we'll wrap up at this point.
Yeah, and I just want to say before we do that, I mentioned that we do have sort of an assumption checklist for people doing benchmark retirement. I didn't mention that we do have Excel budget forms if you'd like that, or just checklists about other things to consider. We did offer those before, but if you didn't get those or you'd like to have them, please shoot one of us an email and we can send a PDF out to you for that. So I do want to say happy Thanksgiving to everyone. I think I had a couple little things here, little sayings that I thought were helpful or nice. Showing gratitude is one of the simplest yet most powerful things that humans can do for each other. We should count our blessings, but we should also make our blessings count. And with that, I wish everybody a happy Thanksgiving and holiday season.
Same here. Happy Thanksgiving, everyone, and thank you for participating in our webinar. And we'll have more. So if you're interested, please, you'll be hearing from us shortly.
Great. Thank you.
Thank you, everyone.
Bye.